Good morning, everybody. Welcome to the Flow Show. I hope everyone can hear me okay today. Morning, Kay. Can I hear you today?
Good morning, Ryan. Do you hear me? Do you read me?
Yes, we do.
Okay, good
Everyone's
morning.
loud and clear. Good stuff. Whoever afflicted my machine yesterday is all fixed and fine and dandy. So all good. Right. Big day today. CPI day, the biggest day since the last biggest day, which was about 2 days ago. And we shall get into what's coming up for that one. But let's get into what's happened overnight and since yesterday. Over in good old China, apparently Chinese government has asked local government to cut private and public projects. This story apparently dropping because of high debt levels in local government centres around China. That all these projects are going into are getting them heavily in debt. So they want to stop these projects. And but on the flip side, there was a headline out saying that they're going to be looking at China's going to be looking at injecting 137 billion in new funding for the housing market, which is not real new news. Although maybe we finally got a number on it. They've been threatening this all year, but Bloomberg decided it's quite enough to drop that in, and that saw dollar China dip a little bit on that headline. The China Security Journal says that they may cut the reserve requirement ratio again this year. Again, one of the things that has been touted since the last RRR cut, and also other rates may be getting cut as too. The NPR, LPR, we've got the LPR this weekend, so we'll see if they decide to tinker with that one as well. Speaking of cuts, over in Japan, they are still looking at corporate tax cuts or tax breaks, according to Yomiuri. The last headline we had a week or so ago was that they would consider the government would consider tax breaks, corporate tax breaks, if wages were 5% or more. Well, now Yomiuri say that the watermark for that is 8% wage hikes, which would be absolutely huge if it's generalised across a lot of the sectors. So that, according to Yomiuri, is the bar set for those tax breaks if they happen. Our mate Suzuki was out and about answering questions on FX. Same old guff. Would refrain from commenting on the FX level to avoid impact. I'm not sure what impact he's looking at, apart from putting a number on it. Says the government will take the appropriate response on FX and then throw out all the usual jawbone bingo, as we might call it. Need to move in line with fundamentals, blah, 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 blah. So no change on the DEFCON level for jawboning at the moment. BOJ's Uchida also out saying he won't comment on FX levels either. He says that the Bank of Japan is aiming for price rises accompanied by wage hikes, and it's key whether wage rises or wages rising will support consumer spending. BOJ's Masaki says he doesn't see long-term interest rates to greatly exceed 1%, even with the rising pressure on yields. Well, they're in charge of keeping it from exceeding 1%, so that's a bit of an open door comment on that one. S&P's Jordan, we will not hesitate to tighten monetary policy further if needed. We're well in the rate cut game, as I'm sure you're aware by now. We've been touting it happening long enough. Over in Sweden, SEB economists, that's SEB Bank, that's the Skandinaviska Elskilda Banken company. Yeah, Elskilda Banken.
This is Candy.
Yeah, Scandies. So they expect the Riksbank to cut rates in September 2024. I might start noting down all these calls because these early calls are not going to have much effect on the market, but it's if they start coming closer and closer depending on the data, that we're probably likely to start seeing some real moves about. But everyone's getting their little ducks in order. So SEB see Riksbank cutting in September 2024. Just to keep it on the cut expectations, gold is don't see a US rate cut until Q4 2024 due to strong GDP growth. Then from that point, they see a cut per quarter through to middle of 2026 for a total of 175 basis points in cuts. Morgan Stanley, they see things being cut a bit faster. They expect the first Fed cut in June 2024, then in September, and then every meeting from the fourth quarter onward, all in 25 pip cuts. They're looking for a rate of 2.375 by the end of 2025. So as you can see, a lot of people coming out with their cut estimates now, and a lot of variation between them. Yes, mate.
Have you seen UBS?
No, I didn't see UBS.
They call for
I did, yeah.
Cuts in March, and
375 pips or something, wasn't it? They're looking for.
Yeah, they are going for the full Monty, and Fed nearly back to not pre-pandemic, but somewhere pre-pandemic rates were very, very quickly. So UBS is the boldest call there. But then, they're Swiss, and they hired people from Credit Suisse probably. So
yeah, well, there's nothing until we hear from Nomura, who, as I said yesterday in the room, will probably be calling for negative rates by next March and QE by April. We'll see. But as I mentioned, what we look for, what I'll be looking for is if the moment the market isn't really listening to all these bank moves, but the market starts to get too extreme dovishness compared to the fundamentals, that's potentially going to be the first trading opportunity I'm going to be looking for to fade on that. But at the moment, as I say, everyone's just lobbing out their ducks and seeing if they line up. So we'll get an idea. It gives us an idea of roughly what the market is potentially looking at. But as already mentioned, they're all over the shop. 3 banks and 3 different calls. So we should have to wait and see. Right, just coming back to the UK, and I've got a bit of data out this morning, some of the jobs data, because they're still faffing around with this. And speaking to Michael Brown, my mate Michael Brown yesterday, and the reason we're not getting all this data is because no one's responding. The survey people, the people who are being surveyed for this data are not responding, or there's a lack of response. So either everyone's bored with telling them what's going on or whatever, but they're having to scratch around to find out what exactly is going on in the ONS. So we get what data we can. So it's mainly wages data and unemployment rate and claimant count stuff. So really on the employment stuff, a little bit better. The unemployment rate didn't tick up again. It was expected to go up another pip. It stayed unchanged. So that's in one way good news. Claimant count was up a little bit heavy, 17.8, so a little bit negative there. But the 3-month rolling employment change showed a gain of 54,000, was expected to drop nearly 200,000. So that's a little bit of a boost there. On the wages front, headline wages came in at 7.9%, so hotter than expected, but still confirming a drop from last month's 8.2, but still sticky. The ex-bonus number coming in as expected, 7.7% versus 7.9% prior. So a little bit of easing. If we see inflation coming down further, then that pushes the UK into population to real wage gains, which have been pretty negative for a lot of the year. In respect to these numbers coming down, they're still very hot. I would have been expecting this to come down a lot faster, but it just shows there's still a lot of price pressures, wage pressures in there. Still got some industrial action going on around the grounds. So, just something we need to keep an eye on, because it just might mean that inflation stays a bit sticky as well. Over to Germany. Well, let's go through some of the other data first. You can see some of the Swedish data there. CPI, again, sticky, but not as much as expected. Was expected to rise 2 pips, came in unchanged, still well up. Most of the measures there well up. That one went a bit higher. The constant interest rate one. PPI, Switzerland, again, little bit higher, not down as much as expected on the year. So you're getting the message now. These are the final numbers from Spain, so largely unchanged there, still well above ECB's targets. Bit of a surprise from the German ZEW numbers. Economic sentiment coming in at 9.8, much larger than the 5 expected, and the first gain in 6 months, the first positive number in 6 months. However, current conditions still looking pretty awful, minus 79.8. And the euro took a bit of solace from those German numbers. GDP wasn't anything to write home about, 0.1% on the year, minus 0.1% on the quarter, bumping along the road. But there was a bit of positive sentiment from the Eurozone ZEW, which also saw a decent jump. So yeah, the euro took a little bit of a leg up on that, Kay. What do you make of the data?
Yeah,
End of the negativity, time to price in more hikes?
Okay, it was expected for the ZEW to come up a little bit, but we do have a bit of a beat on the sentiment there. It's a bit like Mark said in the room, like current situation is dreadful, but there's hope. It reminds me of those of the Japanese manufacturing numbers. They most of the time come out pretty poor, but the next month is always expected to print plus 3.5 or 5.5% or so. But yeah, what I also said is that if you're just ahead of those US data, and something I noticed is that people seem to take a little bit of refuge into the second biggest block. Not necessarily because the data are really good, but today they've been helped by those data. But it looks as if the euro is kind of used to steer away from too much dollar exposure, perhaps, versus the others. And we see those euro crosses tick up, and that happened regularly before, ahead of US data. So perhaps this afternoon, if the CPI overshoots in the US, that euro move could be undone. But just something I noticed that has happened over the past months, really. Yeah, for the rest, it's still hopium, but as we've also said, at one stage they have to hit the worst, and just perhaps the worst is over for now. We don't expect a huge or a very, very severe winter, although we cannot always rely on those forecasts. But it may just be that a mild winter can turn around some of the European and specifically the German data, which is one of the engines, of course, of Europe. So yeah, it hasn't gone by unnoticed. Euro dollar ticked up about 25 points or so, and then all the euro crosses are higher. So despite pretty decent numbers out of the UK, if you take the revisions into account, euro sterling is still higher from where we were pre-numbers. The one thing that I took from the Jordan comments in the S&P, and that's why I'm keeping a very close eye on that euro Swiss, is that yes, he did repeat all the warnings that they could continue to hike and etc., etc. But then he did add this time that they may be in an okay place. They need to, of course, be data dependent like everybody. But this is one of the first times, if I recall correctly, over the whole cycle, that he said that they may kind of be where they wanted to be if there are no big surprises on the upside for inflation or other numbers. So I found it just that little bit interesting in his comments. And that's it. For the rest, I mean, somebody has to tell Bank of Japan that they should stop being. I think all those people are long dollar yen or short yen at the Bank of Japan, because they really are very counterproductive for the yen, right? Yeah. Saying that they don't expect the long term yields to go above 1%. That's what the market kind of expects as well. But if you're Bank of Japan and you're giving the market another reason to slap the yen, it's not really going to help your importers and even your economy, because everything you import is getting more and more expensive, right?
Yeah, exactly. So, yeah, it's this. Well, we've still got to sort out this Canada business as well. And as
Quiet
usual,
around there, right?
yeah,
I
yeah,
think it has to do with the Japanese
mentality.
pride. You
Yeah,
know, it doesn't really look good to have to let one such important person go. So I think that's one of the reasons why they are very quiet about it.
yeah. They don't suffer scandals like you would. You don't get scandals every day over there like you do over here and
Yeah.
elsewhere. So it can be a bit of a big deal, but we'll see what comes from that. Now back to some of the squawkers. There hasn't been too many, thankfully. ECB's Kazakh says that he sees no clear peak in wage growth yet. There's a risk of that spilling over to inflation. One of the big hawks at the ECB there. He's constantly worried about inflation and the potential for more hikes to come. We have had a central bank talking about cuts. The Mexico central bank, Governor Rodriguez, saying easing inflationary outlook means that they could start discussing possible rate cuts at future meetings. That was in Mexican press, but added the caveat that any rate cuts would be gradual and would not necessarily imply a cycle of continuous reductions, and that they're not expecting to start talking about rate cuts this year. So getting the one central bank, getting it primed up, getting it teed up and potentially ready to go, but then giving the conditions for those cuts. And that's probably a good indication of what every central bank's going to talk like. These cuts are not cuts for, they're not going to be potentially a cycle. It's getting rates back to neutral levels rather than just cutting because growth is falling off a cliff. The trade's going to be where the growth does fall off a cliff, and then they need to keep cutting past neutral to inspire growth. That's the tightrope these guys are walking at the moment. New York Fed had some expectation surveys out. The consumer largely doing okay. Inflation expectation for 1 year dipping a pip or 10 pips to 3.57% from 3.67%. So that's one metric showing falling inflation expectations. We've seen them going up in the other consumer sentiment surveys out of the US. Over on the our game of can kicking 2023, the US House is to vote on a stopgap funding bill today. We'll see what that brings there. Okay, got any other headlines swinging across your peepers?
No, just a reminder that the APEC conference starts in San Fran today. So we're expecting the Xi Biden meeting tomorrow, but I guess we will start to get doorstep comments rolling in from this afternoon, probably, and I think that's about it, right? You covered all the rest, or anyway, what's important. I don't know if there's any individual stock watchers among our audience, but note that at the Dubai Air Show, Boeing struck some really juicy deals. I don't know if the company already reacted to it, their stock, but just on the side of things, know that those big airline companies are striking new deals, but Boeing seems to be taking the lead on that one.
Yeah, and DHL, apparently they're expanding over in, I think it's Hong Kong they're expanding, and they're also looking at new aircraft. So a bit of a pick me up for the airline sector over there. And when you get logistic companies like DHL looking to expand their fleets, that gives you a bit of an indication that they don't see any big growth worries on the horizon. Because if they did, if they saw activity dropping, they wouldn't be splashing out on new planes. Although that deal may happen over the course of a couple of years. Right, let's take a quick look at what's coming from the US CPI. So we're all up to speed on that one. Headline CPI expected to drop back to 3.3% from 3.7%. The core, the all-important core, expected to come in unchanged at 4.1%. So what's the real price risk here? Well, the market is, you know, it's one day it's up, one day it's down. One day growth is good, then you get a softer number and it's a bit wobbly. We know the market is pricing cuts, so this is what these numbers are going to be. Anything that's hotter, the core higher, CPI not coming in as low as expected, is going to fall into the Fed's rhetoric. Or, you know, we heard from Powell slightly more hawkish at his last outing, so that might see the dollar rally, yields rally, hike expectations rallying as well. Whether that's lasting or not is another matter. What I think would happen is we're going to get more rate cut talk if these numbers come in softer than expected, particularly on that core number. Even if it comes in at 4 or dips below 3.9, that'll be enough to say push the last hike further off the table, and all the cutters will be getting their Tipex out and rejigging their numbers. Just keep half an eye also on the earnings numbers as well, just to see if there's any pullback from what we saw via the NFP data as well, because these numbers get updated here also. What are you thinking for this one, Kay? It's really a coin toss, really. Could inflation go up a bit, or are we heading much lower?
I mean, we were talking about it briefly in the room this morning. It's really I've seen both sides of the expectations being called. It's really for me it's a flip the coin. Comes off, then that's going to have a pretty big impact on those numbers. But then other articles are talking about health insurance prices going up, which would in turn push inflation a bit higher. And it is really a flip the coin. I think the market is very willing to trade weaker data. Inline may not move the market much, and I'm taking a bit of sticking my neck out there a bit. But it's all going to be about what the results are after the thing, because we are, as we know, not too far away from quite important levels on US yields, and it's really for me it's a toss the coin. I'm actually not having well, apart from my long-term silver, but that's a completely different position. I don't have anything in dollars going into today's numbers, and I'm actually already thinking that in line with what we saw past weeks and even a couple of months, that the more medium-term players may be waiting for a package like CPI, retail sales, PPI out tomorrow, those kind of things, you know, and then take a direction, and we are going to have not too much more than algo blips today. But yeah, I think the market really wants to see lower CPI numbers, because that may be the easier trade, sell dollars and buy bonds.
Yeah.
But that's about it. I think if it's an overshoot, and I'll have a look at the S&P, then we are perhaps in danger to have seen a bit of a recovery top there in the S&P if the numbers are really higher. But yeah, I'm going to react instead of anticipate, really.
Yeah, as we've said at the beginning of the week, this is another week where you've probably got to take everything as a whole and see where you are at the end of it. But the market's going to move between each data point anyway. I think for trading, we want to see big variations. You know, as Casey said, coming in round expected, probably not much of a move to be had. But that's why you need to look at what markets are doing going into these numbers. You know, we know Euro is looking particularly strong at the moment. So, you know, if there's not too much of a hot number or too much of a soft number, maybe you get a dip in the Euro. That will be the way the side to look well. So, yep, just roll with the punches, pick your levels, or sit on your hands and wait to see what comes of it. So that's the data for that one anyway. Let's look at some of the price moves and a bit of fun and games yesterday in dollar yen, right on the option expiry. Just sitting here, and suddenly it's trading in 151.90s, and the next minute it's trading 150 down here, 151.20, and the usual speculation coming out, everyone rushing around trying to guess what it was, the wires popping up saying it was the fact that it happened right on expiry time suggests there might have been some option related stuff going on there. There wasn't a big expiry yesterday by any means, but you never know the stuff that we don't see there as well. So we had a bit of a cage shake, if you like, a tree shake, got the market a little bit nervous, and I think that set the tone now. The market just a bit nervous, a bit like when we were up at 150 originally and we got that move down that everyone thought was intervention. The market is a bit nervous. We've been saying it all through this move. You know, you don't want to be buying it up here in case something like that happens. And you've got to be careful with shorts because nothing's happened. But if you manage to get some pips out of that, you did very well. But you don't look the gift horse in the mouth. So for now, we're holding below the highs. We can't get back up to those highs because I think that nervousness is in play at the moment. People looking at that and thinking, what the hell? And it just shows you any little twist and turn up here, people are ready to hit that sell button, get out, ask questions later if they're long. Yeah, I guess we're here waiting to see what the CPI does. As I mentioned, it's gonna. I think we might be setting up for similar as what happened at 150, where if we can't get through this, and if we get hot CPI numbers and we can't get through this level up here, 152, then we might be setting up for a similar bit of consolidation below and needing another trigger to get us through it. But you never know. We could get a break over the CPI, and then I'm talking rubbish. But for now, I think there's a bit more nervousness in this pair for the moment. So yeah, euro dollar climbing back up over 107. I'm not getting too excited about this move either, unless we get back above or have a crack at this prior high and this level up around the fib, which has been the resistance point after recent breaks of 107. Then I'm not going to get too excited because it just means we might be ranging. But look to see if we get a bit of support coming into 107 on the test. We've had a go previously to try and build it, but it hasn't lasted. So we're not out the woods which way this one wants to go, although it is maintaining its bullish bias for now. So keep an eye on that one. The commods, DK in a room asking why are commods looking fairly weak around the grounds. You can pick a few of them if you like. Aussie, CAD, not looking too good as well, still looking a bit weak, and that's even while oil's again just creeping up a little bit. We're moving further off the bottom, looking a bit more bullish, but it's still all small stuff until we start taking out some of these bigger levels out here. What are you making of commodities? And put you on the spot now. He wanted some clever heads to tell him what was going on. What's going on with commodities? Just a weak growth story, no reason to...
Okay, as you showed there, oil is rebounding, but we are still pretty much below bigger levels. The Kiwi has been weighed down by weaker data that we saw end of last week, start of this week. The Aussie is a bit in the middle of the road between those two, because it's actually strengthening versus Kiwi and mildly strengthening versus Canadian dollar as well on the crosses. So the Aussie is a little bit in the middle there, and is likely going to follow risk, and partially between risk, partially between what's happening to the dollar. And I think, is it overnight that we will have the Aussie labor report, or is it next? Let me see. No, it's actually from Wednesday into Thursday for us, so it's tomorrow night that we have the Australian unemployment report. So that may be a mover But yeah, that's somewhat in the middle of the road. The thing is as well, commodities are weak, but it's also a factor of the euro being strong, because you can look across the grounds, and yeah, commodities are weak versus euro, but then euro is strong versus everything. We are, after all, not more than 25, 30 points away from the highs in euro sterling that we have seen over the past months. Look at euro Swiss is trying, even euro Swiss is trying to rebound. Not even talking about euro yen, but then you see euro Aussie, euro CAD, euro Kiwi, they're all higher, right? So it's a factor of several things. Roberto is asking why euro may be so strong. I think it's a fact. We've been talking about things like that, like in relationship to the Chinese yuan as well. You know, at one stage, data come out as they were expected, being weak, but the market is trying at least, or starting to perceive that we may have hit the bottom, and that's where the market also always try to anticipate. Oh, it can only get better from here, and I reckon that is one of the reasons why the euro is perhaps on the strong side right now. And also, as Ryan already mentioned as well, ECB started to hike after the Fed, and some market participants must have like being perhaps short euros and things, and then now starting to think, oh, but if the numbers start to accelerate to the downside in the US bloc, we may actually put a little bit more money in the euro versus the US, and you have those subtle flows that we don't always see. But if you look at stuff for the DAX, for instance, the DAX is relatively strong, right? And we may see a bit of rebalancing between markets. And I'm not saying it's going to continue. I'm not saying that euro is going to trend 10, but we have to, if you look at the global picture, we have to acknowledge that since we hit 105 on the euro a couple of times, that thing is holding pretty well and better than other currencies. And that's why those euro crosses tend to go higher. But yeah, back to the commodities. Yeah, I think the explanation is really in the Kiwi data. Canada, there's also a bit of housing uncertainty lingering there in the background. But for the rest, yeah, you know, markets come and go, and for the time being, the markets are probably getting more out of positions than entering new positions.
Yeah, and you've also got to look at the rate divergence as well. You know, with the ECB around the 4% mark, and you got everyone else in the 5% rates. There's potentially more cutting to come from those than there is from the ECB. But yeah, I mean, you know, everyone's been talking about recessions here, recessions there, and that sort of talk can strike a bit of fear into markets. But you know, we've just seen Eurozone GDP 0.1%, minus 0.1%. You know, if you get 2 quarters of negative GDP, that's a recession technically. But who's going to give a monkeys if it's 2 quarters each of minus 0.1%? It's not the Eurozone collapsing. And I think that's where you need to make see the context, make the significance between what is the recession going to look like if there is one. You know, a deep contraction, that's bad news. Minus 0.1 recession, couldn't give a monkeys about it. It's not going to tip anyone into QE or anything like that.
And we also know about it for months now.
Exactly. We've seen it coming from Germany for long enough. They've been the poster boy for weaker growth, and you know, we've seen some other countries looking not too bad, Italy and Spain and the like, not looking too bad. But overall, the block isn't looking overly hot, but not looking disastrous either. So sometimes, if you know, a lot of moves come on fear of what's going to happen, the worst case scenario. And then sometimes you've got to translate that into prices. If the market's saying recession, but euro dollar can't get through 105, well, that's telling you its own story. It's telling you that the market is seeing something else. And if it ain't going down, there's only one other way it can go. Does it mean we can't go down further? Of course we can. I'm still wary of this because we're still below this level here, this 38.2 fib. Get above that, then I'll start to think we're really turning around this trend. But until then, you know, 3, 4 going into next year, we might be coming down and breaking through and making new lows. Who knows? But all we can do is trade the price action. And at the moment, we've got the range 105s, 107.60s. That's all we need to worry about unless you want to get messing around in the middle there. I'll have a quick look at cable, then I'll palm it off to the K-Meister. Here we are, back in the middle again. We've had the little move up, we've had the little move down. Now we're back in the middle, 123s. That's our marker. Again, another range play here. I'm not interested in here. 121s or up at 124, 124 and a half. That's my areas of interest. And what it does in the middle, I'll let you guys deal with that one. So yeah, middle of the road for this one. We know it's been a bit of a level prior, so big figure as well. So no surprise to see it holding a bit up here at the moment. CPI, we could be back at 124, we could be back at 122. I would think though, just watching this bounce here, if we do get another move down here, unless it's really, really hot, hiking type CPI data from the US, I think any dips today are going to get bought up in any pair versus the dollar. That's just my viewpoint on that one. K-Man, did you want to grab a couple?
Yeah, but if you keep just a minute on the chart, and I was saying in the room when we did the dip under 122, it had the same feel as those prior dips below 121, and
Yeah.
it could be that your 122 is your new 121. I just want to stick on there on the chart for a minute, because I was also looking at it, and you look at those little prior spikes. If you look just a little bit left, it's that 122 could become your new 121, and that is perhaps something that we need to watch over the upcoming days, really, today, tomorrow, on the rest of the data tomorrow, and this could get really interesting. I'd love to see a dip down there, just to see what's happening there, because it's sometimes, you know, it's just as simple as if people don't get enough what they wanted around 121 or below, they move up their bids, and regardless what comes out in the data, really, those bids will hold the market. So I really think it's starting to build up as an interesting level, just around that 122, just sub 122. So it's going to be an interesting watch. If we crash through, of course, then we're talking again about the outside of the ranges. But I think it's going to be an interesting enough watch.
Yeah, thanks, mate. Right, I'll hand it over to you. While I'm doing that, Gordon saying that De Guindos has been touting higher inflation. Yeah, he was. It's a bit of an open goal, that one, because we're coming into winter. We know there's going to be price pressures in energy and stuff, particularly for the Eurozone. So it's not going to be a surprise if we see some inflationary pressure coming into the latter part of the year. So he's not telling us anything we don't know at the moment. Over to you, mate.
Right. Yeah. Thanks, guys. So, okay, quick look at the differentials. We're still not moving a lot, right? This is sterling and the dollar. We're still not moving a lot. So this is still pre-data, wishy-washy, managing the books, and etc. etc. This I expect over the next round of data. We have UK data tomorrow as well, if I'm not mistaken. What do we have tomorrow? Yeah, tomorrow we have CPI, of course. So expect those differentials to start to move, okay? And depending whether we break above here, this is probably going to be not too far from the 124 if we are back here. And if we start to move above, watch out with the cable. And this is probably going to be your 122 again, the underside of the differential. So keep an eye on what's happening there after the numbers. On the euro side, we had a little bit more of a bounce. That explains also your bounce on the euro. But again, we're still in this kind of block where we've been trading inside over the past months, really. And if you look at the ranges, apart from some blips outside some of the boxes on the euro dollar helped by those euro crosses, but the euro dollar has been relatively stable, and that's what I've been saying as well for a while. Euro dollar could be relatively stable and the rest gravitating around, and that's what makes those euro crosses move as well. At the same time, euro dollar is not really picking a fresh direction. I do expect these things to move in the next 48 to 72 hours if you take into account the what was I going to say? The claims and stuff and those continuing claims. Okay, US 10s. This is going to be relatively important for dollar yen, among others. Of course, going to drive everything. But if you want to see dollar yen come down, which for once I would like to see, because I bought a cheeky 150.5 put for a week yesterday. We need to see this get down back below those prior levels, 453, 450, 447. This is your zone before we can go deeper, perhaps down into the 440s, low 440s, or even 430s here. For as long as we are staying in this range, probably there's not going to be too much happening with the dollar. Now, if we start to have those, or if we get very sticky numbers here, this is your first resistance here, 68, 70 on the 10s, and then but I think the big level really will be here, 480. I'm not sure that with CPI data alone today, we are going to be able to get up there. So I would say 68, 72, and then on the underside again, those low 450s. Watch that. If we get down there on a bit of a weaker CPI, bond market should do well, equity market should do well, dollar should be really on the defensive. If we start to break, then it's bad news for the dollar, I reckon. But again, I'm not sure if CPI has the power to break this. It's rather on the short end, probably, that we are going to see bigger moves if we get a weaker CPI. We for instance can go and have a look back at what's happening in the 480s on the twos, for instance. I want to show the S&P today. We are hanging around this trend line here, and upcoming are another couple of really decent levels in the 44.30s and up to 44.60. If you get a weaker CPI, but not a if we get a weaker CPI, bond market should rally, the yields should go down, and this should really go and test this higher zone. I imagine. I haven't put a FIP on this, but yeah, you see, we are hanging around the 61.8 of the move as well, so that adds a bit of importance to this zone. If we start to get back below 4,400 on a sticky CPI, we have to look at the underside of the zone here, and that's 43.30 to 43.50. Okay, so these are your levels to watch on the S&P, and I think we have had such a dynamic move higher. The market is probably looking at, okay, we are going for a retest of this one, but is it going to happen is really the question. So watch out if all of a sudden we see a little bit of a spike and then start to come down as well. Okay, I expect this one to move as well. This should be a decent mover before the end of the week. I'm going to have a pretty close look at it. Ryan already mentioned the cable and the euro dollar. I want to have a look at the Aussie dollar. It looks a bit confusing, this chart, but you know, I know where my mess is. Okay, this is a trend line here on the Aussie dollar. This is the Aussie dollar. This is the daily, okay? You got the 55 DMA around here. You got the leading span around here. You got the trend line around 64 the figure, and you got the underside of the cloud around 64 the figure. that is an easy enough level, okay, to watch on the Aussie dollar today and going forwards in this week. 64 the figure, pretty easy, big figure, and a lot of action up there. So that's your level to watch for the afternoon and for even the rest of the week, to see whether we get closes above, whether we get tests and rejections, etc., etc. If it breaks, I think then we are probably trading 1% higher in not too far a distance. Kiwi is a bit weak. We had weakening data. We have been trading under this under the 58.90 now for a while, but especially under this 59, those low 59s. This has been capping since we went below there. Been going on for nearly a week now. That's 59.10, I reckon, is going to be your level. If we go back above, then we're probably going to trade back into the mid 59s or 60s on weaker US data. But if you get a bit weaker US data and the Kiwi refuses to break above 58.90, 59.10, then we're probably going to look at lower levels here. As I said, the data are a bit weak in Kiwi land. If it's Aussie Kiwi you want to play, we are breaking trendline resistance. We did it, I think yesterday we broke it, and we are, yeah, it's bid really. Watch for a retest of 108.25 to see if it holds for a move a bit higher. For the time being, I would not counter this unless we get a weaker unemployment report out of Aussie land in what is it, 36 hours or so. There is, yeah, Swissy. If you want to steer away from the dollar, Euro Swiss is on a bit of a mission here. We are entering resistance since we have broken above the trend line, and we have also been supported by the cloud. We are entering a little bit of resistance, 96.65 up to 96.95. Keep an eye on that zone, because I found SMB Jordan starting to look or sound a little bit less hawkish than it was in the up to now. And dollar Swiss, on the contrary, if you want to look at the other side of the dollar, is on extremely interesting zone, in interesting levels. Okay, so we have, if you look at the here, the DMAs, right? I'm going to put my cursor here. Everything is happening between 89.95 and 90.08 on the daily moving averages. We have trendline support around here. If you go to the 4-hour, we have also the 4-hour cloud, which lies around here as well. Everything's happening around 89.90, 90 the figure on dollar Swiss. So this is a very good one to monitor going into the US data as well. Dollar Swiss, if we start to break 89.90, this could all of a sudden look very weak, or could accelerate to the downside. That for the Schweiz. And you know what, Ryan? I have shown what I wanted to show, so I give it back over to you.
Thank you very much, mate. Wise words as always from your good self. Yep, we'll call that a day today. Come and join us on F.A.C.E in just over an hour and 40 minutes. You can get even more from the team ahead of that CPI data, which we'll cover live. Thank you, everybody, for coming to the Flow Show. Have a great day. We shall see you all tomorrow.
Hello.